Wonderful. Thank you very much, Simon. Good afternoon, officially, everyone. Great to see you, and thank you to Scandex for having me here today. So I'm going to talk a little bit about how to build a rock-solid risk management strategy. Now, I've only got an hour, and I'd probably take a lot longer than this normally, but what I want to do is give you the key elements that I think every trader, regardless of whether you're a swing trader, day trader, whether you're trading currencies, commodities, whatever it is you trade, these elements need to be factored into your process. And really, I think the title should have been risk management process rather than strategy, because strategy implies that it's purely just about the physical trade, so where you might have your stop, where you might have your target. But risk management is so much more than that. And the reason I put so much emphasis on this is any new trader that comes through my trading room will go through a 42-point questionnaire, regardless of whether they've been trading for 5 years and not getting the results they want, or whether or not they've been trading a couple of years or completely new, because part of risk is not just, like I've said, what percentage you risk on your trade or what percentage or what size risk to reward you have. It's about how you actually approach the market, and there is no one way to do it, because I don't know how any of you are trading. I am not going to sit here and say that the way that I trade is the only way, but there are elements of what I do that should be involved in every single trader and every single trader's process. And the reason I can say that is because personally I've been trading for nearly 20 years now. I've been teaching in a trading room, and I've had a trading room, and I've been running that for nearly 10 years. And if you spend about an hour, I'm spending about an average of 9 hours a week with students working on their strategies, their results, their psychology. After a while, you see patterns, and one of the major patterns that you see is how traders approach their risk management, but also what happens to their risk management under certain conditions. Because to me, a trader is only as good as when the pressure starts to hit them. And pressure can come in different ways, which we're going to talk about as we go through this. But what's interesting is I, in the last year, have started running my own fund. And with that comes a whole different set of risk management criteria. But the way I approach the market and the way that I trade in that specific fund is very different than how I trade in my account. I'm also still taking the same types of trade, but the amount that I risk, the length that I hold those trades for, that changes. So it's not going to be a one size fits all today, but what I'm hoping is that you will take away key elements with you that you can apply to your trading. All right. And the reason I think what you're going to get is so important is I often get the call, not so much from the hedge funds, but the retail traders that are struggling. I have coached and mentored city traders and a couple of hedge fund managers, but most of the people that I'm working with are retail traders, because it can be a lonely process. They can be out there on their own. And I often get the call when they can't get to that point where they're consistent. But one of the problems is they don't understand what that consistency should look like. So we're going to talk a little bit about that today. And I've also worked with guys who run podcasts. There was two guys from the Two Blokes Trading podcast that were losing money constantly, and I got them to turn that round. And part of it was not just a simple risk management process, but also their view on how they specifically traded. So yeah, trading the fund has given me a whole new perspective and it's challenged me and how I manage risk, because for me it's important as somebody who trades and coaches others to step up. But as I've said, most importantly, you don't run a trading room and you don't call trades and you don't spend time coaching others and have your risk management not work. You have to have this process in place. But the important message here is, regardless of what it is, there's going to be times where your risk management process is going to feel like it's not working. And I'm going to show you how you get around that as well. So the number one issue that I find, whether it's retail traders with a couple of months experience traders who've been trying for 2 or 3 years and can't get the results they want. And one of the things that challenged me in my early days was this: too many traders spend too much time and base their resulting risk management actions on whether the previous few trades were winners or losers. So what I'm basically saying there is that most traders are focusing too short term. They've got an element of recency bias behind what they're doing. And we're wired as human beings to do that, to focus our energies on what has happened more recently. But the challenge with that is very often stops get moved, the percentage of risk per trade fluctuates based on whether the previous trades were winners, losers, or whether or not they're simply going through a period where they haven't got a lot of trades, or they've forced the last 2 trades, or they've stuck to their rules on the last 2 trades and they haven't got the result they wanted. So too many traders' actions around risk management are based around winners and losers, and based around on the fact that those winners and losers are often what's happened recently. So why is that? Well, ultimately, it comes down to fear and greed. So it comes down to fear and greed, but also different traders around fear and greed look at that differently. So a trader will often overestimate what they can achieve when they are winning. Now, I don't know about you guys listening to this, but I have experienced this. I've seen this firsthand when traders get on a winning run. They start to fall into 2 camps. They either start over risking and breaking their rules, so they increase the risk on their trades. They become casual about their analysis because they're feeling overconfident because they're on a winning run. Or I see traders underestimate what they can achieve when they're losing. So they lose faith in their strategy very quickly, or they try and make back losses too quickly. And that's where their risk management plan that they had, if they even had one in the first place, starts to go to the wall, because what they're doing is they are basing their decisions on the success or lack of success that's happened over a very, very short period of time. So rule number 1, and this is what I teach all of my traders, is set up your risk parameters and your risk processes up as if you are the worst trader on earth. So go into it expecting the worst. Imagine that you're going to hit your worst losing run that you've had, even though you've got a strategy that shows over a period of time the results are profitable. You're looking at a win-loss ratio of 65%, a risk to reward average of 2.5 to 1. Even if the stats and the numbers show that the strategy is good and the strategy is successful, set your risk parameters up as if it was the worst strategy and you're going to be the worst trader. Because what I see so often is traders will start talking about moving stops and are acting as if they're going to be winning on 80% of their trades, rather than setting up their risk parameters first as if they were going to hit a losing run of 80%. So with our traders, when they take a new strategy, if they're looking at a worse losing run of 3 trades, we automatically double it and base their risk parameters around that, because the trader has to be able to cope with the worst case scenario before they can start thinking and worrying about optimizing and moving stops. So set your risk parameters up and your processes up as if it was the worst trade in period you were going into. Now, that's all well and good, and you might be thinking, well, okay, great, but what things do I do in that? So it's all well and good saying you need to set this up and having a few cute phrases, but what do I actually do? Okay, what do I work on? Well, there are 3 key areas to focus on. A specific set of rules and procedures. Number 2 is you want to be testing and accumulating data. So that can be back testing a particular strategy that you have, and it's also accumulating data as you go forward. But it's more than just logging down casually whether or not the trade is a winner or a loser. It's much more detailed than that, and we're going to go through that process very shortly. And lastly, as you can see here, it's about psychology. So there's an element of psychology, but the last 2 here, or I would say actually all 3 of these concepts, rules, testing, psychology, they all interlink. So a lot of people go to a lot of effort to improve their psychology, but deep down, they still don't feel confident about what it is they're trading. Or they've got a set of specific trade management rules, but they're not appropriate for the type of strategy they're trading because they don't have any data on it. So all of these three elements are impacted by the other. So make sure that you take the time to focus on all of these. So we're going to have a look at some of these now. So these would be the baseline risk management rules that I would say to anyone that I was speaking to that wants to be a successful trader. These can be tweaked depending on the type of strategies that you run, the various different variables within that, and the data that you have. But these are a baseline, so I'd like you to make a note of these, or just check in and see whether or not you're applying these to your own trades. First of all, have a predetermined percentage risk that you trade per trade and stick to it. All right, so make sure that you've decided what that percentage risk will be. Now, some people say don't risk more than 1% a trade. Some people say don't risk more than 2% a trade. Okay, again, I don't know very specifically what your strategy's results are giving you and where you are with that. So I would say as an absolute rule, have no more than 2. On one strategy that we run, which I'm going to show you in a little bit, they have or show you the data from it, for 2.5%, but that's because of the trade frequency. But most of my trading is done around the 1% mark. In the fund, the maximum I'm risking is 0.5%. So I can be trading the same strategy on multiple accounts, but I have a predetermined risk on that trade depending on where that trade fits into my risk profile. So make sure you have that and you stick to it. Never widen your risk just for the win. So what do I mean by that? Well, let's say you've had 3 losing trades, or even 2 losing trades. I've seen traders do this after having 1, is what they will do on the next trade is they will very simply double the amount they risk because suddenly they see a potential trade and they falsely look at that trade as if it has a better chance of winning. They think the trade is better. They see an additional technical element that backs the trade up. And what they then do is they risk 2% instead of 1 or 4% instead of 2, and will justify that position by saying, well, if I get this, I will not only recover my losses, I'll be back into a winning position. And that feeling that they have, imagining themselves being back in a winning position or making up their losses, makes them feel good, and then they make the association that the trade is going to have a better chance of winning when they have no idea whether that is true or not. So you don't widen the amount you risk just for the win, or once you're in a trade and the trade is going against you, you don't widen the size of your stop because you want the win. I've seen traders do this, and I've seen traders widen their stops because they've been in a trade for a period of time. I've seen traders widen a stop because a previous trade that they were in ends up losing, and then they widen the stop because they now don't want 2 losing trades consecutively. So for me, never widen the stop. Once you're in, you're in. The only reason you would ever change your stop once you're in is because you've made a mistake and you've put your stop in the wrong place and you realize that, or you have a specific trade management plan that allows you to move your stop as the trade moves in a certain direction. I'll discuss that and trailing stops as we go through today. So here, only ever choose to drop lower, not higher on risk. So for me, within my process, I do have the option to go in to a trade on a half stake basis. Now, what I mean by that, or half stake, half risk, is if I'm risking 1% on a particular trade, I can go in at 0.5% if certain elements of that trade aren't as high quality in terms of the setup as another one. Now, that isn't me just picking and choosing trades. That's if ahead of the strategy criteria setting up, I am at a level, but the level doesn't have a specific divergence characteristic. So if I'm trading against the trend and I don't have a divergence characteristic, then I can still choose to take the trade, but take that at a lower risk, but not the other way around. That if I see a chart that looks technically more in alignment, or I've got additional things backing up more than what I normally need, I won't go and risk more. So I won't up my risk past my level to do that. Then here, be clear, as I've just said, on what factors allow you to risk less. So at what point is that trade a no trade versus a trade that you can go in at a half stake, all right? Then here, base your maximum exposure on previous data. So a question I get a lot is, okay, I'm risking 1% per trade, Ali, but how many trades can I have, or how many trades can I be in at once? And my answer back is, well, it depends on the type of trade that you're trading. It depends on the type of strategy. So I'll give you 2 examples. You might have trader A, who's in a scenario where trader A is a day trader. So trader A is a day trader and they average 3 or 4 trades a day based on the strategy criteria. So it may be that they look at their numbers and they say, I'll be in no more than 5 trades because the average number is 4, the max is 6, which only happens twice a year. And I know that if all of those trades, remember worst case scenario, were to lose in one day, how would I feel about those 5 trades losing at 0.5% or 1%? So that expectation and that maximum exposure is based on the numbers, but also what that trader can cope with. Whereas you might have trader B, who is a swing trader, and trader B can happily be in 6 positions. And the difference being is there is a lower chance of those 6 positions all closing out and losing on the same day. Now, somebody may argue that, well, whether they lose on the same day or whether they lose all in one go, there's still the same number of losers. And from a numerical perspective, that is correct. But from a psychological perspective, it's much harder if all your trades come in over a shorter period of time and lose. You're more susceptible then to either breaking your rules or backing away. So the trade frequency element has an impact on what you do in that scenario. Then here, stop moving stops for no reason. This is a big bugbear that I have as somebody who used to do this. So when I started out, I lost £5,000 in 3 weeks when I first ever traded. So my kind of risk, the risk fortress went up, and I was like, right, I'm going to make sure I learn to manage my risk. And the 2 things that I did that meant that I didn't move forward even after losing money was my stops were too tight for the type of trade that I was trading, and I was moving them too quickly to either a break even or a profitable scenario. I wasn't giving my trades room to breathe. So when I read in books where they say move your stop to break even, then it's a guaranteed no lose. Yes, you might feel a short sense of relief, but actually you could be taking more risk by moving your stop to break even. The simple premise being that if I have 3 break even trades, that mean I lose nothing on those trades, but those trades, had I given them enough room based on clear criteria and clear testing, all of those trades were 3 to 1s, I could be sitting on a flat return of 9% here. And then if I have 2 trades that full stake losers and I didn't get a chance to move my stop, based on that run, I am now, and it's simple maths, I'm sitting at -2, but up here, when I've had a 3%, a 6%, a 9%, I'm at +7. So part of risk management is not just moving stops. A lot of traders think about it one dimension. They think, I've got to move my stop, I've got to get my stop to break even, I've got to lock in profit. Part of risk management is allowing your trades enough room to be able to get the winners that can act as buffers against the next period of losing trades. Next point. So there, I've said people think removing stops reduces risk. It doesn't always do that, and you have to know the longer term implications of whether or not moving your stop is beneficial. I'm going to show you how you can measure this so you can actually build it into your strategy. And it says there, test the process on a decent data sample, not 3 or 4 trades. So I'll show you how you can do that very shortly. So rule number 2 that I want you to think about and consider is decide on your trade, or decide on the trade criteria and the risk management criteria before the trade sets up. So one way I've seen traders almost go to the wall is when they reach the market and they get to a trade too late. So it's a little bit like rushing for work, or it's a little bit like rushing to catch the bus. Is if you have that feeling where you pull up a market and suddenly you're looking at New Zealand dollar, US dollar, and you suddenly see a trade setting up that meets your criteria. It's very easy in that situation to either get your risk calculations wrong, make a mistake, And what you've done is you haven't spent the last 2 or 3 days or 2 or 3 hours eyeing up that trade and being absolutely clear on what it is you're planning to do. And then often that trade will end up losing, and then you'll kick yourself. You think you shouldn't have traded that position, you rushed it. So the next trade comes along, that's the one where the rules go out the window and you double up on your risk. So make sure that you're ahead on every trade. Don't get to trades late, because you run the risk of messing up exactly what your process and your criteria is. So what I want to do now, because I'm conscious of time and there's a lot that I want to cover for you here, is I want to go through some data points and actually show you a couple of trades, show you some of our spreadsheets, and give you an idea of how you can measure key data. Because a lot of people say to me, Ali, how can I get better at risk management? And the first thing I say is that risk management is actually fairly simple. If you know what it is you're tracking and why. This is the key bit. Why are you moving your stop when price goes in your favor 2 to 1, not 1 for 1? Why is it you're having a stop that is below that particular point? Why is it on some of our strategies you're using a 1.5 times ATR on a 4-hour chart rather than a 2 times ATR on an hourly chart? And the idea is these points have been measured, because it's much easier to stick to a risk management process if you know that there's data behind it. If you're playing a guessing game, or you're reacting to what you see on that trade in that moment, you'll have less confidence, especially if that goes against you. And then what you'll find is you're flittering between different types of risk management, and that can be one of the most risky things. So key things to look at. Now, I've already said at the start that the win-loss ratio is something that traders spend too much time focusing on. Traders naturally want the winners, not the losers. And I have traders, some that are operating on strategy at 65%, 68% win-loss ratio. I've got others that are operating at less than 50-50. So you still need to be able to check, and you need to be able to log the win-loss ratio, and something you need to measure. But it's not enough to react to that on a short-term basis. You're still logging it and cross-referencing against previous scenarios. This is a really important one. This is one that gets overlooked all the time, which I've touched on already, but I want to specifically talk about is trade frequency. So trade frequency can be measured essentially by the average number of trades per day, per week, per month. Get our students to do is not just look at what the average figure is. That's fine. But what you want to do is you want to look at the extremes, and you want to look at how your trades land. So for a lot of our swing strategies, we will have quiet periods, and then we will have 5 or 6 trades that come along at once. So psychologically, for the trader, that can be a little bit tricky, because they are waiting and waiting for a trade, and then 5 come along. So as they enter 5 over the period of a week, they suddenly see themselves as having 5% exposure, because they're looking at it is the fact that they've taken all of those 5. But if they look at their data and they see that there is a pattern to that, especially if they're trading certain strategies, and it might not be that it's exactly 5 every time, but if they can note by looking at their trade frequency that they regularly get periods where it's slightly quieter and where it's slightly busier, and they also can note the extremes, so they can go back over 2 or 3 years data and say, well, I had 2 periods last August where I was in 6 or 7 trades at once. That helps the trader be more comfortable about that, and not just look at the exposure, and then not just be worrying about whether or not the trade wins or loses. So trade frequency is hugely important. Okay, so as a day trader, another way to look at this as well, whether it's a day trader or a swing trader, is how quick your trades come at you. So how quick do the trades turn up? So as a day trader, the simple theory is the quicker and more trades you have, the lower the risk you want to use. Because if you've got one of our strategies, so if I show you our first day of the month strategy, the clue is in the name. If you look here, the first day of the month strategy, here is the live, these are all the live results since we put this out as a strategy to our community. This is a setup once a month. So what you'll notice is the percentage risk is slightly higher, it's 2.5%, but you're only trading once a month, or you're placing 2 orders once a month. So your trade frequency is low, so the risk can be slightly higher. But if you're looking at one of our day trading, or we call this a hybrid, this is a day swing trading setup here. If you look at the data, you'll see on this particular trade, you might end up with 5 or 6 trades in a month. You may even end up with 5 or 6 trades a week on the busy times. So the risk per trade is less. So understanding the trade frequency can then mean that you're comfortable with the level of risk that you have for that particular strategy. Now, really big one here. Big one. A lot of traders don't do this, is they don't clock time in trades. Now, you might be thinking, what does time in trades have to do with risk? Well, I've seen this firsthand when I've coached and mentored 2 guys who are literally trading next to each other at their offices. So they ran a business and they both had their trading offices at the same place as their business. And these 2 guys were in a very similar trade, almost identical entry. And then as the afternoon went on and they were in the trade for longer and longer and longer, what I noticed is Michael was comfortable with the fact that the trade hadn't hit target. But David was uncomfortable about that. And what David did was David got out of the trade early. Now, that might not directly seem like he's been taking any more risk, because both of them had their allocated risk for the trade, right? But the mere fact that he got out of the trade early and took a 1.5 to 1 instead of a 2.5 to 1 means he's taking more risk, because that trade, the ones that if you should be running them to target, if you're not running them to target, you're adding risk. So knowing how long, you can see the column here when I pull this particular spreadsheet in, you can see we clock the number of days, number of hours if it's day trades, that we're in trades for. Now, we don't simply look at the average figure with that. What we will do is we will look at outliers, we will look at what the average is, but we'll look at what we call an eyeball average, because what that does is it helps with an expectation. So for example, the 2 live trades, or 2 of the live trades that I'm currently in, you can see them here. I've been sat in these now for the best part of getting on for 3 weeks, but I don't stress about it. I don't get out of them early. I don't move my stops when it's not part of the strategy. I don't reduce my target just because I've been in the trade longer. Yet I've seen other traders do exactly this. Well, what they will do is they will literally change the trading criteria and change the risk and get out early and mess everything up because they've been in the trade for what they think is too long, rather than simply knowing the criteria or knowing the data around that. So for me, it's very important that you log the time, whether it's hours or days, that you spend in a trade. Then 2 really important pieces of information: longest losing run and worst performing period. And these are about expectations. And I'm going to bring in the other one here as well. So longest losing run, worst performing period, longest winning run, best performing period. So this is something that we look at, and I think this is especially important for day traders. So what our spreadsheet will do is we will calculate the longest losing run and the longest winning run. So it gives you a perspective of your best performing period flat out, your worst performing period flat out. And if you're testing, you can do the same thing. So it allows you to have an expectation of what that strategy could deliver for you in one go, worst case, best case. But more importantly, we will also go down, and if you look at the spreadsheet here, one of the things that we will do is we will not just look for the best winning period. So let's say we will look at the best performing period, because the best performing period, so for example here, could have a series of winners and losers in there. And obviously you can see there's the risk to reward on those trades. And then I'll look for the worst performing period, which is not just the most number of losers in the row, but when you've had a losing run and then you've had, look, so here, look, losing run, a little bit of a winner, then look, losing run, losing run, losing run. So what I'm doing is I'm preparing my expectations so I don't start messing around with my risk, because it's these moments where you as a trader are more likely to want to fiddle around with your risk, change what you're doing. So best performing period, worst performing period, longest losing run, longest winning run, key factors. Then here, One of my absolute favorites, maximum drawdown percentage on winning trades. So what do I mean by this? Well, I believe as a trader, you should be recording your maximum drawdown, whether the trade wins or loses. But essentially what I'm doing here is if I've got a trade that sets up, trade triggers, goes past the entry into drawdown, what I'm doing is I'm logging that drawdown relative to where my stop was be. So let's say we keep this simple and I'm looking at a trade here, 2-to-1, entry, target, stop. So yes, this trade was a winner, great. But what I want to know is what or how close did that trade get to my stop? Not so I change what I'm doing, just so I have an awareness of that. But I also want to know, and I'll just show you this, I'll show you this on the spreadsheet, is what I also want to know is I want to be able to take my winning trades. So I filter my winners and not be obsessed with the win-loss ratio, but focus on my winning trades. And then what I want to do over here is look to see how many of those trades, if I stop loss, this is giving me the size of my stop loss in points, then how many of those trades, in fact, what percentage of those trades, and I can just get rid of all the figures here, what percentage of those trades went into some form of drawdown, even though they ended up being a winner. So let's say, for example, if I knew that on 75% of all my winning trades, I go into some sort of drawdown, and the average time that I'm in a trade for is the minimum time is 2 days, and the average time is 6 days. I go into that trade with a greater sense of what is more likely to happen. Again, I'm less likely to move my stop when I shouldn't, and I'm less likely to get out of the trade if I have that information to hand. So if I know what my percentage of winning trades that go into a losing position before they hit target, that puts me way ahead of the average trader who's just thinking once a trade goes against them, I hope the trade wins, or they widen their stop, or they move their stop tight because they'd rather react to the trade that's in front of them than being proactive about it. And then here, maximum retracement. So moving stops. This is what I want to focus on now for a few minutes, because moving stops is one of the questions I get most often. So I'll get asked, Ali, when should I move my stop? Or is it a good idea to move a stop? Or should I use trailing stops? And the answer is, unless I know exactly what it is you trade and your specific strategy, any answer other than I don't know is the wrong answer, because I shouldn't be able to say, do this, until I can look at your data, until I can look at your results, and actually look at the process by which you trade. Now, on my strategies, I know exactly when to move stops, and on some strategies, we don't even do it because the data doesn't stack it up. So actually on some strategies, if I was to move my stop to break even and feel like I'm taking less risk, I'm actually in fact taking more risk. So let me give you the example of what max retracement essentially means. So maximum retracement is really simple. Let's say we're working on an entry here, a stop up, a target up here, and a stop down here. So a simple 2-to-1 trade. So I'm in the trade, and let's say I want to look and say, is it a good idea that when I get halfway to my target, I move my stop? So when the trade reaches a 1-for-1 rather than a 2-for-1 up here, is it a good idea to move my stop to break even? Well, all you simply do is whether or not you did it on the trade or didn't, okay? So this can be something you can test. So whether it was a live trade or a tested trade, you go back and all you simply do is essentially the max retracement is the most price went against you after it reached halfway, 1-for-1, before it reached the target. Because then it's really easy for me on this trade. I can see that my entry was here. Let's just say it was 100, and my target was 300, whatever, doesn't matter. It's a 200-point target. I can see that when we reached 200, price came down, but it didn't come down and hit my stop. So what that is essentially telling me that on that trade, it would be okay to move my stop to break even once price reached halfway, and then I would still get my 2 for 1. So what I've got to go and do is I've got to basically go back and look at all of my trades, and then I can understand whether or not it is okay to do that simply by looking at what the result is giving you. So if I just bring in, bear with me a second. So if I bring in some of my trades, what I will do on some of my trades is I will look to see whether or not it is okay to move my stop. Let me just show you the columns there. So what you'll notice here on these first lump of trades, when I was demo trading this, before I went live on this particular strategy, what you'll notice is that it was okay to move my stop at a certain point once the trade reached it, apart from one of the winning trades. So all of these trades here, it was fine to move my stop, apart from one of them where it went below it before it hit the target. So what I was able to do on that particular strategy was say, right, now I'm going to go and trade it live. I can actually move my stop on that strategy when price reached not 1 for 1, but 2 for 1. So this particular setup, on the entry, I'd get in at this point, this would be my risk, my target would be 3 times that. Exactly the same as the 2 trades I've shown you. So I'm working on a 3 to 1 risk to reward. But when I went through the data, what I realized initially was if I moved that when the price reached 1 for 1, too many of those trades were stopping me out at entry and ending up going on to reach 3 for 1. But what I noticed with that strategy is once reached 2 for 1, even though they did retrace, once you reach 2 for 1, there was a high probability of reaching 3 to 1. So what I was able to do is put the rule in that I move my stop not at 1 for 1, but at 2 for 1, bring that up to break even. So on the few trades that did come back the other way, rather than losing 1%, breaking even. And I could see overall that it was improving my results. So my stop movement potential was not at 1 for 1. My stop movement potential was actually at 2 for 1. And that was the key point for me. So that can be the difference between creating more risk, thinking you're being safe, and actually enhancing your trade's profitability. And then one of the last ones that I want to show you is trade expectancy. So again, trade expectancy is something that has a huge impact on a trader's mindset. And again, they're to stick to a risk management process. So a trade expectancy is just very, very simply where, based on the trades that you're looking at, whether or not the trade gives you, okay, it gives you a certain percentage regardless whether the trade wins or loses. So the easiest way to explain it, if I just draw it here, is if I have 100 trades and I make 100%, my trade expectancy, regardless of whether or not I had 50 winners, 50 losers, regardless of my overall risk to reward, 3 to 1, 3.5 to 1, whatever it is if my result, if my number of trades is 100 and my result is 100% return, my trade expectancy is 1% per trade, regardless of what the result is. So what that does is that also helps me to stick to the risk management plan I've got. So if a trade comes along and it loses, and then another trade comes along and it loses, then I know that as long as I'm following my plan and I'm following my strategy criteria, that actually within that is a trade expectancy. So psychologically, I can teach my brain to say, I'm still banking a percent here, because when the winner comes along, what that winner is going to do is win 3 times, 3.5 times that. So trade expectancy is another very, very useful tool to keep your risk in line and keep you from breaking rules. And then the last one, I think probably the most important and the big turning point for me, is when I focused on risk to reward rather than win-loss. Yes, I track win-loss, but my goal whenever I'm trading is to make sure that my risk to reward is significantly higher than my win-loss. So over time, I'm less concerned about what my win-loss is, and I probably average about 50-50. On a good year, I might be nearer 60, but I'm only winning 50% of the time. But from a risk to reward point of view, then I'm looking anywhere I do have some strategies at 2 to 1, but most of my risk to rewards are 3 to 1 or higher. And what that allows me to do is focus on the result process to get to that, rather than whether or not the trade wins or loses. And what it also has allowed me to do is, when I have a bad month, I'm not focused on the winners and losers. So you should be able to see here, everyone, you should be able to see when was it? Yeah, last August. Yeah, just coming in. So you've got a couple of trades. You've got the majority of trades here in August. You see that there. All right. And then you've got a few trades here in July. So it's a period of just over a month. And what you'll actually notice here is that's when they were opened. All of the trades closed in August. So we're just looking at the closed trade results in August. And what you'll notice here is I actually had 7 losers, 2 winners, and we'll count this £23 trade as a break even. Okay, and this one here as a break even. So 2 break even trades. I managed to just get a little bit out of that one because of, I think that was slippage, and that one I got a P&L just below. So we'll take those as 2 break evens. So what I'm looking at with 7 losers and only 2 winning trades is a loss of £52. Okay, why? Because winning trades are significantly outstripping my losers. Now, the majority of traders, when I get the call to help a trader, the majority of traders, if they've had 7 losers in 1 month and only 2 winners, are significantly worse off percentage-wise than I was here. So I was essentially almost at break even relative to the size of the account. Yet the majority of traders, if they have 7 losers and 2 winners in a period of a month, are going to be a lot worse off than that. So again, I can't emphasize enough how focusing on risk to reward will make a huge difference to what you're doing. Now, I want to focus on one thing psychologically that's helped me, and I get my traders to do this, because it's easy to say to a trader, have a long-term approach. But one of the key things to do is, well, how do you day to day, when you see the trade moving against you, you see the trade moving in your direction, you have 2 winners on the trot, you have 2 losers in one day, 2 losers in one morning. How do you maintain a long-term approach? And the way that I talk about this to traders is to imagine that you're looking out, you're sitting in a boat or sitting on the shore, looking out to the horizon. And what I say to a trader is that it's very easy to make one trade bigger than it is. And if you imagine the expanse by which you're here is your entire trading career, 20 years, 30 years, however long you're going to trade for, and you're looking out, and when you remember that one trade is a tiny dot on the horizon, what that does is it helps put the trade into perspective, because psychologically, a large portion of traders are treating the trade they're in like it's life or death, and the result in the same way. So what I do is I get my traders to come to zoom in on that trade so that they are focused on setting the trade correctly. But once the trade is placed, come back out, put the trade into perspective. Remember that it's one trade in your next 1,000. So actively think about the perspective that you need to give that trade. So you step in and you step away. And again, that will help you take the emotion out of the trade so that you are not focused completely on the result. And there's other things you can do with your breathing exercises. There's all different things that you can do, but having the idea of imagining each trade on the horizon, and actually how in the grand scheme of things the one trade doesn't mean a huge amount from the result, helps you put it into perspective. So in summary, before we finish up, there's a couple of things that I wanted just to say before we finish up. So plan every trade ahead. This helps you be clear on your plan, stick to your rules. It reduces the number of mistakes. So plan every trade ahead. Never increase the risk. So don't increase the risk once another trade loses. Don't increase the risk of a trade or one stop once another trade comes along and loses, or because a trade is going against you. Keep that risk the same. Measure the data points that I talked about, and you can cross against your behavior. So one of the things when I started out, the first thing that I realized, and this was after talking to my mentor at the time, is if I had 3 losing trades on a morning, so I started out as a day trader, if I had 3 losing trades on the morning, invariably my trade frequency, which averaged between 2 to 3, my trade frequency would then go up and I would hit 5, 6, sometimes 8 trades. Now, I had to be aware that sometimes there were more trades coming along, but invariably the majority of times where I would trade extensively in the afternoon is if I had 3 losing trades in the morning. So I was able to track that data and then psychologically see how that affected my overall analysis and what bits of my strategy that I was choosing to ignore. So when your trade frequency is higher, measuring those key data points trade by trade is very important. So I was able to cross-reference the results with the behavior, as you can see there. Then only move stops based on a set of data-proven rules that I showed you a little bit earlier. So don't sit there and go, oh, should I move my stop at 1 for 1 or 2 for 1? I'm going to move it at 1 for 1. Actually know whether or not the data supports you doing that. And then take a longer term view or longer term outlook. And this is important. Yes, you need to track things trade by trade, but regardless of whether you're a day trader, a swing trader, or a position trader, you want to have a long-term outlook. Our position traders have a 3-year outlook and a 1-year evaluation. So they will look 3 years before they will change anything significant, and they will evaluate every year. But our swing traders have a 6-month evaluation, won't change anything unless it's been a year. Day traders, it's a 3-month evaluation, but again, probably won't change anything from 6 months towards a year. So it's not that you're changing things too quickly. You're analyzing the data, but you're giving what it is you do enough time to actually work. And then focus on risk to reward, not on win-loss. Focus on risk to reward, not on win-loss, and track that and look to improve it. But before you just try and trade for something longer and try and catch a 3 or 4 or 5 or 6 to 1, make sure you know that the strategy you trade has the capacity to do that. And a final thought. I mentioned this at the start, that even the most tested, proven, effective risk management process will have a day, a week, or a month where it can feel like the worst. And some of my students have spent hours testing a way of managing and trailing stops, and they've optimized their data. They have the best risk to reward window, and they know from a 3.2 to 1 up to a 3.8 to 1 is optimum for that strategy, and they will only move their stop once price reaches 2 to 1. They've gone to all this effort and work, and then the first week they trade it, what they have is a setup where it gets to 2 to 1, they move their stop, and it comes all the way down, stops them at a break even, and the same thing happens on the second trade. So you have to allow for a bit of random distribution, and no matter how much effort and how sophisticated your process is, there will be a short-term period of time where it can feel like the worst. That is not a reason to move away from it, and that is not a reason to walk away from it simply because a few trades make it feel like it's not working as well as the overall result. Good, so I hope that was useful. I am here for questions. If anyone has got any questions about what we've covered or anything that I could potentially help them with.
Fabulous. Ali, thanks. I'm reminded of that old Peter Gabriel song, Don't Give Up. I think
Very true.
The key. Brilliant. Oh, there we are. Look at all that feedback coming in. Brilliant presentation. Thank you, Ali. That's great. Oh, there we are. Let's have a look and see. Now, Conrad posted a question 10-15 minutes ago. He said, Ali, your presentation is absolutely fantastic. I have noticed that you are in both the New Zealand US dollar and the Australian US dollar at the same time. In terms of risk management, those two pairs are highly correlated. What is your opinion around the risk exposure and correlated
Brilliant.
trade? Good.
Do you know what? I'm so glad somebody picked up on that because I was hoping somebody would. So again, I'm really pleased you picked up on that, Conrad, because on face value, it looks like what I've done is I've doubled up my risk because I've just gone, oh, there's 2 potential trades here, and I'm gonna take them. Now, my primary focus is I will take a trade based on a set of technical criteria. So the challenge is, on a short-term basis, these trades look very similar. So one of the things that you can do if you're looking at it one-dimensionally is go, well, why would he take that? Because essentially it's potentially the same trade. So essentially, if I was risking 1% here and 1% here, then what it means is I've essentially doubled up my risk, but I haven't, and there's a reason why. Because what I have is I have a whole series of data on that particular setup. So I know that over 5 years of testing that strategy, and actively trading it now for just over 18 months, that particular setup, that on numerous occasions, and you'll have to forgive me because I can't remember the exact percentage, on numerous occasions, you will get pairs, especially, you'll get this on majors, but you'll also get this on cross pairs. So you might have one major, Aussie US dollar, and then another one, Aussie New Zealand dollar or Aussie yen. So sometimes you'll have two majors in the same way, and sometimes you'll have one major and then a variety of cross pairs relating to that major that's set up in a similar way. So on the face value, it thinks, well, if I risk 1% on one of them and then 1% on another, well, what I've done is I've increased my risk. But those particular trades and that particular strategy is assessed based on each market and each setup over time. Does that make sense, Conrad? So on the face of it, it looks like I'm doubling up, but I have the data that tells me that over the longer period of time, that doesn't impact me. And in fact, if I only choose one of the two pairs, one of the two setups, essentially, I'm then rolling the dice because I then don't know. I could pick New Zealand dollar, US dollar, and Aussie US dollar hits target. So short term, I might end up having two losers. So let's say two losers at 1%. So on the short term of it, it looks like I'm worse off. But actually, if every single time that occurs, I take the relevant setups, then what happens is I may have a greater drawdown, but then I'll have a greater return. The challenge is if you try and pick one or the other. So for me, I stay away, even though I understand the cross correlation between currencies, I stay away from that because I have a data sample and a data pool to override that. I'm not saying using cross relationships between currencies is a bad thing, but just for me, I was never able to quantify it to a point that I could fit it into and feel comfortable with it. For me, it felt like, well, sometimes you'd get a scenario where one of the pairs would go a little bit further than the other, or one would turn and then the other wouldn't quite over a short-term period. So for me, I would rather have the data and know that. Exactly, you're right. Yeah, it goes back to the data analysis. Yeah. So for me, yeah, on face value, it looks like I'm just smashing out my risk, but actually I'm being very, very measured by what I'm doing. And that's that idea of sometimes with the strategy I trade, more than one bus coming along at once. The risk is if on one scenario you do it once and you pick one of the pairs, and then on the next one you pick both, and then the next one you pick one, and what you end up with is the same setup the board, but one trader has taken each one, had the losers, had the winners, and maximized it, and then the other trader has traded one, and that was the one that didn't quite reach target, and then the next time traded both, and they both lost. So now they've had three losers. Can you see how the profitability can drift with just 3 or 4 scenarios? Good. Hope that answers your question.
Thank you. Oh, so right, there's a few more questions come in here. I'm trying to see if we can get through just a couple of them in the last couple of minutes that we've got. The 3 prongs of trade frequencies again, please ask Izzy if is that possible to
yeah,
just
one
to recap.
second. So you've got it's trade frequency. The 3 prongs that when we're analyzing data: trade frequency, win-loss ratio, risk to reward. So essentially, when you manipulate one of these, it will often have a knock-on effect on the others. But in terms of the 3 factors that make up an effective risk management plan, you've got rules and procedures, and that's for your analysis and your strategy and your trade management. It's testing and data, because that helps give you the confidence. So it's accumulation of live data or demo data. So testing and data. And lastly, it's actively working on your psychology. And you've got a gentleman very proficient in that speaking tomorrow. So actively working on your psychology, and then realizing that they all affect each other. So rules and procedures, testing and data, and your trading psychology, and then trade frequency, win-loss ratio, and risk to reward. And then I'll just pull the other slide up so you can see that. So you've got the list. So there's the key data points that you want to measure for effective risk management. We will look at probably another 10 or 12 data points, because we want to also optimize strategies in lots of different ways, and also relative. So some of our against the trend strategies, we will look to optimize those differently than some of our with the trend momentum based strategies. All right.
Fantastic.
We've got time for a couple more, maybe, Simon, if I'm quick.
We've got 2 questions coming asking about scalping. Is that good for day trading? Vivek and
okay, good question. Is scalping good for day trading? Again, I would, if you were coming to me, we would assess your decision-making capabilities in terms of how effective you are at making decisions, how quick you are. We would look at your goals and objectives to see whether you actually need to, and what you want to do, because that's partly important as well. So what we find with a lot of traders is that they have this idea that scalping is fun, it's exciting. The most important thing with scalping is scalping effectively day trading. I mean, it depends how you want to class it. Our day traders probably average 2 to 4 day trades a day. Some only will trade in the morning, some will trade in the afternoon, so that will increase it, but they will have outlier days, especially at the moment. So what we're seeing is we're seeing a lot of volatility for day trading. Day traders are having an absolute ball at the moment. Swing traders, it's a bit harder work, but what you're seeing is sometimes that's moving out of that range up to about 6 to 7. Scalping in the true sense of the word is probably 10 trades in 2 hours. The best recommendation I could give you for scalping, I think, is to set a time limit. So I'm going to scalp between 8 and 10, and when the clock hits 10, you don't take another position. You might manage the current positions you are in, but you don't take any more, because the risk is with scalping is if you're down in that 2 hour period, or you're down for the morning, you are much more likely to come back, stay for another hour, or come back and trade for another afternoon. I don't know if that makes sense. So the biggest thing is not whether scalping is good or bad, is that have you tested the strategy? Are you good at making decisions quickly? You can potentially automate some of your entries with robots, but most importantly is set a time limit to it based on what the data is telling you. Otherwise you risk going down a rabbit hole of chasing back profit, trading, you know, silly little things like trading Forex into the lunchtime break. I've seen that with scalpers, and then they're getting new highs, new lows, they're dipping into the market, and there's no volatility, there's no volume there, and then they end up having 3 losers because they were chasing the 2 losers that they were meant to have that morning, or the 6 losers, or whatever the result was that morning. So they've ended the morning unprofitably, and they've chased it into the afternoon and ended up in a worse position. So set your time parameters if it's something you're going to do.
Fantastic.
Cool.
Vivek, thanks all. Ali, it's an answer to my question and a very informative session. So yeah, I can't agree more. Thank you so much. And I know we keep having questions coming in if we had the time, but unfortunately, if we don't, we're going to have to call it an end there. To get in touch with you, just to search up Traders Support Club.
Yeah, if you just head to tradersupportclub.com, you'll see my ugly mug on the website. So if you just find it there, and if you hit any of these buttons that say start right now, what that'll do is it'll take you through, and you can just sign up for some free material. So we've got some free training. We talk about the the Trader Support Club 4 pillars. So you can go in there and just pick up some information, and we do run regular free webinars. We're doing a Q&A one in the summer as well. So if you don't get any questions answered here, you can sign up for free, get access to our free membership area, and then ask me a question at that webinar. So, or you can catch me Instagram, Facebook, search Trader Support Club. You'll find us out there.